Okay, welcome everybody to today's webinar on estate planning for self-managed superannuation funds and the various considerations. So, look, what I'm planning on doing today is running through a number of, I guess, the key considerations from trusteeship all the way through to the benefit payment stage, and highlighting a number of elements that certainly I've come across over the years from the ATO, and more specifically from a number of private rulings that have been issued in the last sort of 6 to 12 months. I've kept a keen interest on a number of key issues with regards to the payment of death benefits, and particularly from self-managed funds, as to how they might impact some of the decision-making elements of succession planning as such. So, what are we going to talk about today? Basically, we're going to look through our trustee level considerations, some of our fund level considerations, then the member level considerations, and finish off talking through this concept of member benefit versus a death benefit, which has kind of been an issue that sort of came relevant, or became sort of relevant through conversations between industry and the tax office over the last 12 months. And there has been a number of scenarios that have arisen where the question's been asked: is a benefit a death benefit or a member benefit? So rather than spoil the end of the presentation now, we'll come back to that to finish things off as we wind down the session. So this is what we're going to look through, and really it really covers off, I guess, from the structural side of things to the decision making side of things. So when we look at the trustee level considerations, we're looking at such matters as the definition of the fund, what the deed says, and then the validity of nominations or instructions that are provided by the members. They're the key issues there. Then from a fund level, we drill into such things as the timing of when a member passes away and what that might mean from particularly for those in retirement phase, whether there's exempt current pension income deductions to be maintained, any insurance proceeds that are coming into the fund, how they're going to be treated, and any other particular deductions. And so you'll see a reference within this webinar to the last webinar that I did in June, which talked about the insurance and the link between insurance and transfer balance cap, and obviously in light of the Div 296 stuff, and where insurance might sit there. So there is a flow between today's webinar and last month's webinar, and so definitely, if you need to go back and review that, then that's something I would recommend, particularly with regards to the whole tie-in between insurance. So I'll cover off on it again today, just briefly, but not to the length that I did last month. And then from a member level consideration, talking through the issues such as binding death benefit nominations, reversionary versus non-reversionary. So I've effectively created that, or turned that into a bit of a debate. And that's always interesting when I debate myself in regards to these issues. But I want to highlight what I consider the key issues with reference to reversionary versus non-reversionary, with the capacity for me to sit as firmly on the fence as I can, despite having some preconceived and relatively strong occasional positions on whether one should go with reversionary or non-reversionary as such. But I want to make that a balanced conversation as we sort of move into those member level considerations, and then contemplating such things as the transfer balance cap, minimum pension obligations, and tax. And that's where we start to look at some of the key issues, such as who is a tax dependent from a death benefit point of view, but also that concept of member benefit versus death benefit as well. And there's been, in the last month, so since I last did a webinar, we've actually had the ATO release their final version, and I say final in the sense of recent updates of the when a pension ceases and when a pension commences ruling, TR 2013/5. And so, we've seen, I guess, clarity on issues that we expected, or we basically knew what the ATO's position was, but now it's been finalised in their wording and the way that they use wording towards, what would determine whether something is a reversionary pension or not, but also issues around minimum pension obligations and what that might mean from a fund point of view. And that can create issues when it comes to estate planning and that as well, which will form part of that internal argument between reversionary and non-reversionary pensions. So let's kick things off and let's look at some of these trustee level considerations. And again, a lot of these aren't necessarily new to us. It's just a regular I guess a regular reminder, because what I like to do when it comes to these sorts of issues, and talk particularly about estate planning, is I put it on the same level, if not more important, than things such as the investment strategy. And that's not to downgrade the requirements from an SMSF investment strategy. It's more to ensure that whilst we are legislatively required to regularly review the fund's investment strategy, there's no such requirement or mandate on us from an estate planning point of view. But I think it should be part of any annual review that a fund undertakes anyhow, to make sure that it's got everything under control. And we deal with estate planning, we deal with death benefits all the time within this industry. Now, you may within your own client base not have to deal with it on a regular basis. So you might only have clients passing away sort of every few years or whatever, which is great in the sense of maintaining clients, but it's not so great in maintaining process and understanding of what's required there. So to me, it's one of those areas that we should be reviewing regularly, to make sure we don't get ourselves in a position where somebody does pass away and we don't actually either have valid documentation to satisfy the requirements from potentially a compliance or an audit point of view, but also to achieve the outcomes that the member themselves wanted, and ultimately end up in some form of stalemate, or worst case scenario, end up as one of the various case studies or cases that I'm going to reference throughout this webinar. And of course, that's one of the key things, is we know from an industry point of view that there is every year at least 2, 3, 4, if not more, estate planning cases that are relevant to self-managed super funds, and largely relevant to binding death benefit nominations and the like, that give us just a few more answers into how things need to be processed. And what we want to make sure, certainly what I want to make sure from an education point of view, is that I'm not quoting cases that belong to all of you at some stage in the future. And so, it's really about trying to future-proof the fund from having to go through any legal sort of stoush between beneficiaries and family members and things. And so it's really about trying to have that plan in place and trying to best as possible cover off against these issues. However, in saying that, generally when a member passes away and beneficiaries and family members find out the size of the pot as such, then inevitably there can be fights. And that's one of the things that, the more we put in place and the more we communicate with these things prior to that point in time, then the less, certainly from a legal point of view, the less chance there is for these fights to occur, at least in the sense of the court processes as such. So let's look at these trustee level considerations. So when we're talking about trusteeship in the event of death, we need to work out what happens from a control point of view, because the way the legislation is written is that it provides for the ability to potentially appoint new trustees and have others come in to act on behalf of the member, but it's not mandated. So there's permission provided within the legislation to appoint the legal personal representative, but it's not a mandate, it's not automatic. And so it's going to come down to things such as the deed. So what we see through a number of cases, and I've got down the bottom there, the Iapollo and versus Conti, and Worcester versus Morris, just two of the many court cases there where the surviving trustee ultimately wields the power to make decisions, and in those instances, and particularly in the Conti case, the decisions of the trustee were final, and so the daughters of the deceased ultimately did not have any sort of legal leg to stand on with regards to the decisions that were made to pay out the benefits. So we've got this exception within the definition of the self-managed superannuation fund under 17A paragraph 3, where the member's legal personal representative can be appointed from the death of the member. They can be appointed to replace that member, but it's a fairly restrictive appointment, and that is that it begins when the member passes away and ends when the death benefit commences to be paid in respect of that member. So what you've got to look at there and identify is that in certain circumstances, that death benefit gets to be paid immediately. So for a reversionary pension, you're not going to have that capacity to appoint the legal personal representative in place of the member because the death benefit commences to be paid immediately. So, in that sense, you've got to then look at, okay, well, in that position there, the death benefits commenced, even though there might be some accumulation interest and other benefits to be paid out. It's going to be problematic from a fund point of view. So then you have to look at the definition of the fund and whether or not you just have to utilize the 6-month rule to fix the trusteeship up. If you've only got individual trustees, you've now only got one member potentially. So you need to appoint somebody else, someone who isn't the legal personal representative of the deceased member, to come in and act as the alternate or additional trustee of the fund. So these are the sorts of things that we need to understand. But we also then need to have the nuances in place with regards to, do we have individual trustees? Do we have corporate trustees? And what do we need to do with regards to the replacement of a director of a corporate trustee? And so therefore, it's not just about what the deed says with regards to appointment and removal of trustees. It's about what the deed says and what the Constitution says and what the special purpose Constitution will say. So, to, I guess, summarize a lot of this stuff, what you want to make sure is that if you've got a member, and let's call it a significant member of a self-managed super fund, who wants to make sure that they are represented in any decision making that is undertaken, one, they either need to ensure that they've done the documentation around pensions or binding death benefit nominations correctly, or two, they need to make sure that the deed provides for their legal personal representative to be appointed in their place. And then when that legal personal representative is appointed, it's about looking and understanding the voting and decision-making requirements of the fund. And so, we have a situation where trust law ultimately, and I'm taking this back to my very early days in the SMSF industry, when I talked to a lot of SMSF lawyers about how this all operated. And with regards to trust law, they would say that the trustee is a singular concept, and effectively that the trustee has just one vote. Now, of course, we know that when you bring multiple people together, they will have different decisions. They'll have different opinions on certain matters, and so therefore, if there is a stalemate in that capacity to get to that one vote position, then how are you going to determine that? And we've seen over time the evolution of deeds and the evolution of voting powers and things in the SMSF space. And again, do we have an equal voting situation, one vote per person or per trustee, or do we have a proportional voting? And again, if you've got, say, parents coming in with the children, you've got parents with higher balances, then they might like to take that proportional voting approach, where therefore it gives greater power, say, to an older member with more money, for them to have their LPR appointed, because that LPR will have greater voting capacity. Likewise, from an equal voting point of view, if you've got children in the fund and you've got parents and one of the parents passes away, the children could potentially work together to outvote the surviving parent in a decision-making process. Again, we don't want this to be the situation, and so we look at things such as the nature of a reversionary pension, the nature of binding death benefit nominations, to work through these issues. But what we really want to see is we want to see consistency between the trust deed, consistency between the special purpose constitution, and then consistency between the documentation of the pension contract or the binding death benefit nomination. And again, then the pension contract and the binding death benefit nominations, if they coexist, that they both lead to the same result. So that, a pension might be reversionary, but then other benefits are bound by the binding death benefit nomination. So if there's an accumulation interest or otherwise within the fund. So really trying to bring all of that together is the role of both the advisor from a fund structural point of view, but also from an estate planning point of view, ensuring that if you don't have the expertise yourself, that the fund has access to somebody that can provide that expertise, and that expertise comes in the sense that those providing estate planning advice also understand the nuances about how self-managed super funds operate. Now, one of the comments that we often make, knowing that what we do at Smarter SMSF incorporates a lot of the fund documentation side of things, is it's a very common question to get. Can we do a deed update? And so we get a lot of deed updates as part of our ongoing business model. But alongside of that, is there ever any consideration given to the Constitution, and how old is the Constitution versus how old is the deed, and do those things still work together? So having that appreciation between corporate trustees and the requirements of the Constitution, and the super fund deed and the requirements of that deed as well. So these are a lot of the issues that we have to deal with from a trustee level, and ultimately it's going to come down to what does the deed say. So is a replacement trustee going to be required, and what is the timeframes for the removal? Will the fund meet the definition, the 6-month requirement for restructuring to ensure that it meets the definition of the fund? And then, from a member level, which we'll talk about a little bit later, what nomination has the member provided, right, with regards to the payment of the death benefit, and then what options are available. Does the deed stipulate lump sum only, pension only, combination of both? Does it just regurgitate the legislation? So where does it sit with regards to SIS Reg 621 with how to pay benefits out? And it shouldn't just be assumed that because the law says one thing, that the deed says the same thing. And so there is that need for people to be able to identify the various clauses within the deed that provide for death benefits. And again, in however many years I've been doing fund administration and education in the SMSF space, the majority of trust deeds that I see, and generally the people that tend to talk down other deeds are people that have deeds to promote themselves, right? But genuinely, in the majority of deeds that I've seen from an administrative point of view, they provide for all of the right accommodations with regards to binding death benefit nominations and pensions as such. But of course, the further we progress as an industry beyond the sort of the 25 years mark where we're at now, the more advanced deeds are becoming in what they do and don't provide for, which really sort of lends itself to saying, okay, well, if you've got deeds that are dated in the early 2000s, we've gone through significant reform in that time that suggests that, okay, it's probably worthwhile looking at whether those deeds are appropriate, not so much because they don't fit the needs of the members, but do they fit the needs of the beneficiaries and future members of the fund? So what the deed says is fairly important, particularly around that whole legal personal representative appointment, because as I've said, it's not mandatory from within the SIS Act, it's more permissive, and we need to ensure that from a fund point of view that we're meeting all the right obligations. And then, of course, those obligations extend to our reporting obligations, and our reporting obligations are both to the tax office from an ensuring that the fund is satisfying the definition of an SMSF, but also from an ASIC point of view. And those of us that have dealt with ASIC, which I assume is most of the people on the webinar today, we know that ASIC tend to certainly be more problematic in the sense of the ATO from a lodgement and timing point of view, in the sense that if you don't meet the timing requirements with ASIC for the reporting of changes of members, directors, all those sorts of things, that penalties can be issued. What I will say is that from a leniency point of view, where I've had funds that have had to make changes to the directorship of a corporate trustee, and the reporting is done outside of the required ASIC timeframes, that's where I've seen leniency with penalties being remitted from ASIC, is because of the death of the member. So they certainly are conscious of the circumstances and try to help out there, but people need to understand that they've got timing issues associated with the death of a member that they need to be mindful of, which of course also means that where you've got single member funds and corporate trustees and sole directors, that action is taken as soon as possible, because if no action is taken sort of in the short term, then is the company able to act if it hasn't got an active director? So these are all the sorts of things that need to be taken into consideration from a trustee point of view. So let's move on and talk about a number of the fund level considerations, because the bulk of the webinar will sort of revolve around that membership stuff and the member decisions to be made. But once we're sort of conscious of the trusteeship, we also need to understand from a fund operational point of view that there are a number of things that we need to take into consideration and that we need to be mindful of that can be impacted based on the death of the member. So when we are talking about our fund level considerations, we need to be mindful that there may need to be a disposal of assets to pay out our super death benefits, and that's going to potentially have capital gains tax implications. So, this is one of the areas that, from day dot of this industry, it's been an issue of, can we just leave money in the fund? Now that's sort of been covered off quite comprehensively over the years, and that is no, you can't. The money has to be paid out. Of course, it can be paid out in certain circumstances as a pension. So you do have the capacity there to retain assets if you've got a member who can receive a pension, and that can obviously assist in the administration of the fund or potentially in the sale of assets, giving you a longer time frame. But where you don't have that capacity and you have to pay benefits out, then you have to look at the decision of, okay, well, are we going to do something as an in specie? And we'll talk a little bit more about the assets in a moment, but assets are one of those decisions that we have to, address as part of the fund level considerations and what the trustees need to do. We've then got our issues around the exempt current pension income and our, segregation periods and how the actuarial requirements are going to be satisfied. Disregarded small fund assets. So you might have members in one sense who satisfy the requirements of disregarded small fund assets, so they can segregate. But then potentially, if we move across and all of a sudden we've gone from two members who would satisfy the ability to segregate, and you've just got one member who potentially won't have that capacity anymore, then decisions are going to need to be made from a fund administration point of view. Then what is the impact of insurance proceeds being added from a death benefit point, and then claiming a deduction for the future liability if a member passes away before 65. And of course, this is my first sort of reference and my primary reference to last month's webinar when we talked about insurance on the transfer balance cap and Div 296, because in that webinar, I did spend a bit of time focusing on that future service liability deduction, so the future benefit deduction, but also the impact that insurance will have with regards to death benefits and which interest insurance proceeds are paid for. And so, as I was saying last month with regards to this, it's a pretty critical decision to understand where insurance proceeds and where insurance premiums are paid from, which interest, particularly if a fund has multiple interests per member, which interest is the insurance paid from, because that will dictate issues around the transfer balance cap. It will dictate issues around whether or not the exempt current pension income deduction is going to apply on those insurance proceeds or not. And it's going to then have a flow-on effect for things such as the transfer balance cap. So again, I just suggest that you can go back and have a look at that webinar if you need to. So just to expand upon a number of these fund level considerations. So from the assets point of view, as I was just alluding to before, what decisions need to be made, and what's the impact of capital gains tax. So we have we've got the uplift or the whole CGT reset that occurred as part of super reform with the introduction of transfer balance cap. How will that impact it if we have to sell down on assets? Have we got a deferred tax liability that we need to be mindful of? Is that factored into the decision of the total benefits payable? How can we optimize the tax outcomes? So, we've got a lot of self-managed super funds that hold business real property. Often that business real property is going to be linked to the larger member balances. If that larger member balance is required to be paid out because of the death of a senior member of the fund, how's that going to impact the ability of the fund to hold that property? And then if we're unable to hold the property, what is the outcome of having to sell that? Do we look for a third party buyer? Do we have the capacity to pay it out as a benefit payment, a death benefit payment to the beneficiaries of the fund? And then what are the taxation consequences of doing that? Now, those taxation consequences might be linked to the fund tax, so the exempt current pension income side of things versus capital gains tax. It might also be linked to the payment of a death benefit to a non-tax dependent. And if we're paying a death benefit to a non-tax dependent, how's that going to look from a final payment made if we're having to factor in a 15/17% tax liability on any taxable component of the fund. And so, the whole estate planning issue, where we have to focus on not only the tax liability of the fund, but also the potential tax liability of the beneficiary, links into any other strategies that we're playing around contributions made to the fund, and how we look at non-concessional versus concessional contributions, and the ultimate tax situation that arises from that. But of course, it's one of those issues, as I said before, when we're looking at disregarded small fund assets, we're looking at the ECPI side of things, that we have to understand that where a member passed away. I mean, if a member passed away in accumulation, then we've got tax to consider across the board there, unless we can pay a death benefit income stream. But when we're in pension, then we've got that ability to work out, how long does the exempt current pension income deduction apply, and when is the best time to sell down on the investments. Because one thing we know is we can't journal that asset out and in from a contribution point of view. The death benefit actually needs to be paid out of the fund. But one of the key issues about all that is this ECPI once the member passes away. And this ruling that I mentioned before, TR 2013-5, was kind of the one of the triggers. I remember back when it was released in 2013, and actually before that, when it was introduced as a draft ruling, there's a lot of sort of murmurs, or a lot of talk within the industry about the death benefit side of when a pensioner dies, that the pension ceases unless there's a reversionary pension in place. And that triggered this whole ECPI position, and that led to legislative instruments being introduced, and then the laws changing from the 1st of July 2012, which expanded the meaning of what a superannuation income stream was, with reference to the ability for that ECPI deduction to continue on beyond the death of the member, where the pension was not reversionary. And so what we've now got, and have had for 10 plus years, is that the ECPI, right, so the exempt income will apply from the date of death. So this is for non-reversionary pensions, from the date of death up until the interim lump sum is paid, or the commencement of that income stream, and also further up until that final lump sum or income stream commencements, which then kind of alludes to the concept of how quickly must you pay a death benefit out. And this is where the law is still sort of, I'm going to sort of say loose in this sense, but it's not, that's not the correct word. But what I'm ultimately saying is that the concept of a death benefit must be paid as soon as practicable. There is no legislative definition of what as soon as practicable means. And so, there is an element of leniency there with reference to how long a death benefit is being paid. But one of those leniencies is not, well, I'm not happy with the market position at the moment, so I'm going to hold that asset for a little bit longer to try and obtain a better benefit or a better result from the sale of the asset. It's basically got to be other circumstances that dictate the longevity or the timeframes until a death benefit is paid, i.e. decision can't be made because the fund mandates, the deed mandates, that the member's legal personal representative must be appointed. There is a question mark as to who that LPR is, so we have to obtain probate. So that decision to obtain probate takes a little bit of time, and so therefore no decision has been made to do that. Or it could be that there is slowness within the market to be able to sell an asset. So the trustees are actively trying to sell down an asset but they're not actually getting the result that they want. So as in, and when I say the result they want, there isn't much movement in the market and there's no offers being made or whatever, and so that could actually slow down the process. Or if it's sort of non-standard investments where there's not such a big market and less ability to sell the investments, then obviously those sorts of things can expand that period from the date of death till the date that the final benefit is paid out, which expands the exempt current pension income for a longer period. So we've got a lot more, I guess, grace and certainty with references to having or maintaining that period, but understanding, and I'm going to talk about insurance again in a moment, understanding that it's only the balance, basically at date of death, plus the earnings on that balance that are subject to that exempt current pension income. And this is where one of the key things that I spoke about last month was the whole proportioning and the death benefit rules, and so the whole concept, excuse me, of tax-free and taxable componentry, which is important for the final beneficiary and how much tax is going to be paid if they're a non-tax dependent. Tax-free and taxable components are all pretty critical to that decision. And the tax-free and taxable components of a pension are fixed from the day of commencement. However, what we've got is this proportion rule to say that if we've got a non-reversionary pension, so we've got the deceased member and they're receiving a pension immediately prior to their death, and there was no reversionary in place, then any amount, so all the investment earnings that are received by the fund, they are going to satisfy the standard tax-free taxable based on the commencement percentage. However, if you've got insurance proceeds, then those insurance proceeds will form part of the taxable component as they would in a normal accumulation interest, versus in a reversionary pension where the insurance proceeds will take on the same components as the commencement. So it will take on the same tax-free and taxable amount. So all of these things sort of blend themselves to the conversation, both around reversionary versus non-reversionary pensions, but also which interest should insurance be paid from an ongoing basis. And again, not chopping and changing, because the last thing you want to do is give rise to questions as to why certain strategies were done. And if one of those outcomes is a tax avoidance outcome, and I'm not suggesting that that's the way that people operate, but if one of the outcomes is a tax avoidance thing like segregation, but moving insurance where insurance premiums are paid from an interest point of view, if that's looked at from the ATO, then you just need to be mindful that you might have or your clients might have a please explain. Now, I say that in noting also that in the time that I've been dealing with a lot of death benefits, most people don't chop and change. Most people don't change where their insurance premiums are paid from. Most people don't change the nature of segregated versus non-segregated. Most people make a decision and they tend to stick with it, because administratively it can be a lot of work involved in all those issues, and they don't want the pain and anguish of dealing with both the administration side of things, but also the audit side of almost that free please explain scenario occurring. So yeah, so there are a lot of the fund level considerations that we need to take into consideration, and most of them are around the returns on investments and the CGT issues, but primarily the taxation position of the fund are the fund level decisions that we're needing to deal with. But most of the estate planning considerations from an SMSF point of view come from the member level considerations. So the member level considerations are those key areas that we need to, focus on the most when talking to members about what their objectives are with regards to the payment of their benefits when they pass away. Now, these conversations should start right from accumulation. And so one of the things that I've certainly always said is that estate planning starts from the moment that first contribution is made. Of course, it's maybe not necessarily as comfortable a conversation to be having with new entrant members to self-managed super funds. Like, here's my rollover. Okay, well, what do you want to do if you pass away? well, the question of, or the comment obviously often comes back, well, I've just set my fund up, I'm not thinking about passing away. Well, most people aren't thinking about passing away when unfortunately those events can occur. So we need to have the conversations early with people to make sure that they're not leaving the decisions in the hands of people that might make a decision other than the results that they actually want to achieve. And again, it's always going to be a tricky thing to deal with, particularly because you're dealing with the human element there of people that go enter into relationships. Then you have relationship breakdown. You might have single member funds. Those single member funds then um, meet people and form relationships. But again, you start with funds where there were spouse funds, then there's separation, then there's second relationships, third relationships, whatever number. All these things have an impact on the decision making process for estate planning considerations for self-managed superannuation funds, particularly given that the trustees and those making the decisions generally have some form of relationship, or will always have some form of relationship with the deceased, but they may not necessarily have a relationship with the beneficiaries, or they might not have a strong relationship with the beneficiaries, or more to the point, they might actually have a broken relationship with the beneficiaries. And so we want to make sure that regardless of personal relationships, that decisions are made based on the intentions and desires of the deceased member. So what we have to understand then is that from a member level point of view, we need to be satisfied and understand what the cashing requirements are. So what has to happen when the member, or when a member passes away. So therefore, we have to have a good appreciation of who is both a CIS dependent, so who can receive a benefit, and then a tax dependent, so who can receive a benefit tax free, because that's going to change decisions. It's going to change decisions about insurance. It's going to change decisions about the nature of pensions as such. We need to understand what our death benefit nomination instructions are: binding versus non-binding, lapsing versus non-lapsing, reversionary versus non-reversionary pension. All these sorts of things come into the decisions that need to be had, and needs to be made, and will influence the outcomes at the end of the day when a member passes away. Further to that, we then have the additional requirements now of the transfer balance cap consideration, and what I haven't put into the presentation, other than the fleeting comments every so often in the future, Div 296. So whilst we focus at the moment on transfer balance cap, knowing that certain portions of the money must be paid out of the superannuation system, in the future we're going to have the position of, should we pay it out of the superannuation system? And for those of you that have heard me present, on estate planning, one of my most consistent comments with regards to self-managed super funds, and particularly spousal based funds, is we often focus on the transactions in the current timeframes, but when we've got a spouse-based fund, we should be looking at the transaction of what happens when the second member passes away. And it's a common theme that's often discussed in this estate planning point of view, is death benefit one's often pretty easy to deal with, right? Because in many, if not most instances, the benefit will just be transferred across to the surviving spouse. And in a lot of those circumstances, it'll just be transferred across to the surviving spouse in the form of a pension. Now, we've got the mechanics of the transfer balance gap, and I'll touch on them shortly as well, where we say, okay, well, we can't transfer everything across. We can only transfer a certain amount across. And then there's additional transactions that are required with regards to the receiving member and any pension they might already have, and whether they need to act on that as well. But what we have to really look at is, okay, well, that's step one. Step two is what happens when they pass away, right? Because when they pass away, that money, unless they re-enter another relationship, and therefore have this ongoing sort of accordion effect of the payment coming here and then expanding and going to the next person, and then the next spouse, and then the next spouse. But let's assume that that's not actually how life occurs, and that for the vast majority, when that second member passes away, their benefits are going to be paid to non-tax dependents in most sets of circumstances. And what is the impact of the payment of benefits to the non-tax dependent. And probably from a Division 296 point of view, most people sort of are looking at Division 296, and most issues that are arising with Div 296 are around the mechanics of how it actually works. What is raised largely as the most significant issue with regards to Div 296 is if we've got people with more than $3 million in superannuation, it's more about what is the tax outcome from an estate planning point of view when the member passes away, more than what is the tax outcome from a Div 296 point of view. And so, if anything, this Div 296 has really highlighted the ongoing estate planning concerns of self-managed super funds with larger balances, and whether or not we should be taking more deliberate action when that first member passes away to take money out of the super system from a death benefits tax point of view, take money out of the system, fully appreciating that there's other tax consequences by holding that money outside of super. But it really has sort of sharpened our focus on that area, which is why, as we lead into, in theory, what is now 11 months away from the proposed commencement date of Div 296, is for those with larger balances, what decisions do we need to make? And so there's going to be a greater focus, I think, certainly over the coming years, as to that whole death benefit process and who is the end beneficiary, or more to the point, who do you want to be the end beneficiary with reference from a taxing point of those lump sum benefits paid out when one member passes away. So yeah, so we're looking at the cashing requirements, the nomination point of view, the whole reversionary versus non-reversionary, and then the transfer balance cap. And inevitably that leads to the PAYG obligations of death benefit, which then helps us round out that conversation that I said we'd start with, which I said at the start that we'd finish with, which is member benefit versus death benefit. So what we know from a SIS point of view is that our benefits must be cashed upon the member's death. So it's only compulsory time superannuation has to be paid out. And that's a whole separate tangent that I often go down about, the compulsory payout nature of super. Death is the compulsory requirement, and it must be paid either as a pension or as a lump sum. We've got changes, and those changes occurred from the 1st of July 2017, with the way that the tax legislation was worded around the capacity to roll back death benefits, and the interpretation that meant you could roll them back to accumulation. We've got now clarity, and we're 7 years in to the super reform in that regard, to know that once a death benefit, always a death benefit, right? Which means that even if you pay a death benefit pension, that will always be a death benefit pension, and it either has to be pulled out of the super system if you no longer want to draw it down as an income stream. It must be pulled out in its entirety, or just taken as a lump sum death benefit right from the commencement. So we've got no capacity to either mix death benefit income streams with other income streams, and we've got no capacity to roll death benefit income streams back to accumulation. So we look at things, and we look at the whole death benefit requirements. Okay, well, the money must be paid out as a lump sum, or an income stream, or a combination of both. If we're paying a lump sum, then we're paying that lump sum either in cash or in specie. So we can potentially transfer assets to the beneficiaries if the assets become an issue, but appreciating that there might be a tax liability attached to that from a fund point of view, as well as a liability from a death benefits tax point of view from that PAYG. So we need to have clarity. As I said earlier, there is no definitive position on as soon as practicable. So ultimately, we just need to start the process rolling once we have confirmation of the member passing away, to ensure that decisions are made. Now, one of those decisions that needs to be made is, as I talked about before, who can receive the benefit. So who is, firstly, a SIS dependent, which is these are the only people that can be nominated to receive superannuation proceeds directly from the trustees of the fund. So we can either pay to a SIS dependent or the member's legal personal representative. Failing all of that, failing the ability to identify a SIS dependent, failing the ability to pay the legal personal representative, then the benefits can be paid to another party. Very rare, if almost nigh on impossible, to see the circumstances. I certainly haven't seen it occur. I've had it asked many times as a question, and so inevitably it probably has occurred, but very rare in the SMSF space that you're not paying to either a cis dependent or the member's legal personal representative. So then you need to know who that cis dependent is. I've provided that list there, which straight out of any sort of estate planning manual on who can receive a death benefit. The key one there is that when we look at cis versus tax dependency, which I'll come back to and talk about the tax liability there, the key difference there is that a former spouse, so once there's separation that's occurred and finalized, so former spouse generally means from a married point of view that you've gone through that divorce process there. Once you're a former spouse, you're no longer a cis dependent, but you're still a tax dependent. So if for whatever reason somebody wants to leave money to their former spouse, then they would need to actually pay it out to their legal personal representative and then have it treated via the will versus via the SMSF trustees making the decision. You've then got the key issue of children. So children are always cis dependent. So all children are cis dependents, but only children under the age of 18, or children under the age of 25 who are financially dependent. They're the only time that they're going to be a tax dependent, unless they're suffering from a disability. But there's a couple of key additions to who a superannuation dependent is from both a cis and tax point of view, and that is those that are financially dependent and those in an interdependency relationship. And what I wanted to show you here was, this is some of the stuff that I've been looking at for the last sort of 12 months as part of our education pieces. We do a quarterly update. And so I am regularly reviewing all the private rulings that the ATO issue to individuals. And one of the most common superannuation questions, if not the most common superannuation question that is asked, is whether or not somebody is a dependent for superannuation purposes. And so the issue here is largely whether or not somebody satisfies the definition of, excuse me, an interdependency relationship, or whether or not somebody is financial dependent. Now, in all of these interpretive decisions, or all of these private binding rulings that have come out in the last 12-month period, you can see down that list that there's a lot of no's and there's a lot of yeses as to whether or not somebody is in an interdependency relationship. There is only one ruling about financial dependency, someone that definitely didn't meet the definition of an interdependency relationship, about financial dependency. So having an appreciation for the criteria for these issues is pretty critical, rather than just the ability to say whether someone is a dependent or not. Now, and I've got a couple of questions, and I'll come back to those shortly, but I just want to sort of work through this piece about the interdependency first. So the legislative issues, the legislative requirements that we need to be mindful of to satisfy all these definitions from a death benefit point of view. You've got the spouse or former spouse kind of the concept, as I mentioned, the child aged less than 18, or any other person that has an interdependency relationship just before he or she passed away, or any person who is dependent on the deceased just before they died under the common law definition. You've then got this expanded definition of what interdependency relationship is. Now, the only requirement in all circumstances for interdependency is that individuals have a close personal relationship. Now, when you go through the interpretive decisions that I've just provided there, and you've got all the links to it, and you'll all get a copy of when the CPD comes out, you'll get a copy of the slides, and so you'll be able to click on these links, or just type them into Google yourselves if you choose to. One of the key issues about this definition of interdependency and the concept of close personal relationship is the original explanatory memorandum. And so I've made the reference down the bottom there, the close personal relationship, but one that involves a demonstrated ongoing commitment to the emotional support and well-being of the two parties. And one of those factors, because then there's a number of factors that determine what that looks like, is one that is quoted in every single case. And I say that suggesting that I've read 95% of those cases, The one thing that's quoted in all of those is that there is a degree of mutual commitment to a shared life. Now, why do I highlight that? Well, because most of these interdependency relationship yes, no answers are based on parents and their children, right? And it doesn't matter if it's the child that dies or the parent that dies, right? The question comes back to whether or not these people were in an interdependency relationship. Now, in most circumstances, the parties have ended up living together, right? And that's a at the time of death scenario. Um, in most of these circumstances, one or each of them provides the other with financial support. And in most of these circumstances, one or each of them provides the other with domestic support and personal care. So they meet the criteria of B, C, and D in almost all of those circumstances. But it comes back to this degree of mutual commitment to a shared life. Now, in most cases where you've got parents and children, the children don't have this concept of a mutual commitment to a shared life. They've come back to help their parent, or the parent has come back to help the child. But at some point in time, they've made a decision that they want to go off and live their own life. And so that is often what interdependency is going to hinge on. And in all of these cases where the answer is no, it is that situation has arisen where they say, well, there is no commitment to a shared life. And so that can be quite harsh, but that's actually the reality of what the tax office are looking for in those circumstances. So it's one that I want to put in front of mind of people. And the other thing is this financial dependency requirement and what it actually means, and the outcome of the one interpretive decision that was provided there, or private binding ruling that was provided there, was no. And it links to this concept here, which happened right back from this Malik case and Federal Commissioner back in 1999. So it goes back quite a long time. And financial dependency is not a 50-50 thing. So it's not a number as such as a percentage of income being received to determine financial dependency. It's more about that contribution, the financial contribution from the deceased to the other person, is significant to maintain the person's normal standard of living. So if you cannot survive in your normal circumstances without that contribution, regardless of the size of the contribution, well, that will determine financial dependency. So, there's a lot of sorts of issues to come into it. You always have, over the years, presentations around school fees and all sorts of other things. They're not always going to be the factor that determines it. It's quite tight what's going to allow for it, and very rarely do you find that somebody is a financial dependent in that sense. So before I move on to the nominations, we did have a question there with regards to Div 296. It's an additional tax on the earnings in the fund. Would you exclude the contribution in the fund in the taxable income when assessing the Div 92 tax? Sorry, so let me read that again. Would you exclude the contribution in the fund in taxable income when assessing the Div 296 tax? Div 293 would have charged on the concessional contribution if a person had more than 250 income in the year. Concessional contribution should not or should have not been taxed for Div 296 tax purposes. All right, so that's probably a little bit outside of the scope of this presentation today. But the contributions, ultimately, just to really give a quick summary of that, the contributions are not assessed from a Div 296 tax point of view, so they are subtracted out of the earnings calculation. But of course, that's based on the concept of adjusted taxable, the adjusted total super balance. But of course, then the following year, when your total super balance is reverted back to the normal definition, then those contributions will count from a starting balance point of view. But definitely from an assessable point of view, the concessional contributions are subtracted out of the definition. And then what are the things to consider in terms of estate planning if super fund has got term allocated or market linked pensions? Well, the main issue there, one, is we would love to see some form of finality on any decision about legacy pensions and the capacity to potentially wind them up in the SMSF space, which of course we have not got that. So what you have to really determine in that regard is if you've got someone with any defined benefit pensions or compliant pensions, such as market-linked term allocated pensions, that they need to understand that if they are reversionary, right, if they are a reversionary pension, that those pensions need to continue on until the death of the second member, right? So that's if it's automatic reversionary. Now, what they could potentially look at is, okay, well, where else in the marketplace is providing term allocated pensions? Are there any other term allocated pension, market linked pension providers in the marketplace? And potentially, if you want to wind up the fund, that's where you'd have to look. Alternatively, you look and say, okay, well, is it now in our best interest? Why do we have this in the first place? It would have been for RBL or Centrelink purposes back in pre-2006 times. Um, could we potentially look at changing this from being a reversionary to a non-reversionary pension? And if you can do that, then of course, if it becomes non-reversionary, then it would just form part of the normal death benefit proceeds. So that's certainly something for people to look at if they've got any market-linked pensions inside their funds. So just to, I guess, to work through the last few key issues with regards to our member considerations, our death benefit nominations. If we're going to have a binding death benefit nomination in the self-managed super fund, it must be made in accordance with the deed, right? So not in accordance with the law, but in accordance with the deed. And this is the confirmation we received from the Hill and Zuda case. Now, again, what the deed says is going to then require the wording that is used, and we've got a couple of examples there: Cantor Management versus Booth, and Munro versus Munro, with regards to various nominations and various requirements with reference to whether or not the nomination must be viewed or handed to the trustee, whether it's been accepted or not. So we've also had recent cases that have expanded on this Cantor Management versus Booth, like whether or not the notice has been served. And we had one recently, and I don't remember the name off the top of my head, but one recently where the deceased member who had his son in as the other trustee of the fund, he effectively signed the acknowledgement to say that the trustees had accepted the binding death benefit nomination, and the son legitimately argued, well, hang on, it should be provided to all trustees, not just the singular concept here. Now, of course, the son was also going to benefit from the validity or the non-validity of the binding death benefit nomination, but he successfully argued that by the deceased member being also the trustee that accepted the nomination, it wasn't served appropriately in accordance with the way the deed was written. So when we've got binding death benefit nominations, it's critical that we do them in accordance with the deed. And of course, if we're making nominations, is it going to be binding or is it going to be non-binding? Now, in a plain vanilla SMSF, it may not necessarily need to be a binding death benefit nomination. And I'd often argue that we put a great enough emphasis on binding nominations when in a lot of circumstances it's pretty clear cut as to where the benefits should and will be paid. And then trustee discretion is not necessarily a bad thing. But of course, what we need to know is if we want to have a binding nomination, right? Do we want it to be a single level nomination? Do we need it to cascade to other members? Then if so, what does the deed provide for? So there are a couple of the key issues with regards to nomination. So what I will highlight here before I sort of summarize the transfer balance cap and the death versus member benefit piece is this whole argument of reversionary versus non-reversionary income stream. Now, it's not an argument in the sense that I don't want to say that one is better than the other, because circumstances will dictate that. But what we need to be clear on is there's a few real key issues with regards to reversionary versus non-reversionary. One, reversionary pensions always require a minimum to be paid. Failure to pay that minimum means failure to satisfy the pension standards. Failure to satisfy the pension standards mean a loss of exempt current pension income. If you've then sold down the assets from a death point of view, you've potentially got a CGT issue. So that's one clear thing that you don't have for non-reversionary pensions. You don't have a minimum pension obligation if the pension is non-reversionary. Insurance is a win for reversionary pension and a loss for non-reversionary. Insurance proceeds will not count towards a transfer balance cap from a reversionary pension point of view, because the proceeds will occur after date of death, whereas from a transfer balance cap point of view, the value is the value at date of death, right? So in that sense, the insurance piece really works out there. You've got the reporting issue from transfer balance cap point of view. That to me is less relevant in an SMSF space, but it does provide time from a planning point of view. The ECPI piece is kind of, as I highlighted earlier, is not so relevant, because the ECPI will continue for a non-reversionary pension up until the death benefit is paid out. So when you're looking at these two considerations, really it's going to come down to a continuation of pension. So for regular pension payments, it's not going to be a problem if it's a reversionary or not, because you're going to satisfy the minimum. But if they're annual draws and they miss out on drawing that pension down, then it can create problems. And then there's the whole transfer balance cap and insurance piece to be mindful of. So it's a discussion again where one thing that we need to be mindful of with regards to reversionary pensions versus non-reversionary pensions is that for a lot of people, the real issue comes down to whether or not there are other beneficiaries. Because if you make a pension reversionary and then you've got adult children from an original relationship, then they are not going to benefit out of that, and there might be a problem with it. Same with the transfer balance cap. We know our reporting requirements. So you've got the value is reported from the date of death for reversionary pensions, but not credited until 12 months later. Whereas if it's non-reversionary pension, if it's accumulation interest or non-reversionary pension, then the new transfer balance cap is based on the date of commencement and the value at commencement of the new income stream. And of course, everything that forms part of that conversation is the stuff I was talking about before with regards to Division 296 and whether or not it's worthwhile keeping that money inside a super or not. So a lot of factors to take into consideration there. Tax dependency and versus non-dependency. We know that if there's a tax dependency, if everybody's over the age of 60, then there's no tax to pay, and we only start paying tax less our rebates if everybody's under 60 and we're receiving an income stream. But death benefit lump sums to a tax dependent is always going to be tax-free versus our non-tax dependent beneficiary. Now, this is where the whole member benefit versus death benefit. So the matter that I wanted to finish off with and talk about as our last piece was this concept of a death benefit or a member benefit. And that ATO website, I checked the reference again last night, that reference is still up there. The question is often asked, if somebody asks to receive a benefit, so if a member says, can I receive a death benefit, or can I pay money out of my super fund, and the trustees start to go through that process and the member dies while that process is occurring, is the payment of the benefit a member benefit or a death benefit? Now, you'll see that there's a couple of points that the ATO have highlighted there, the terms of the request, the terms of the trustee, all sorts of other things. And there's one word that I've highlighted, and that word is knowledge. So when we look here at the last 12 months and the 1, 2, 3, 6 death benefits that have asked the question as to whether or not this is a member benefit or a death benefit, there is a glaring obvious point there, and that is that every self-managed super fund that's asked a question, the question has come back or the answer that's come back is it will be treated as a death benefit, right? Versus every APRA fund, it's come back as either a member benefit or a mixed benefit. Now, the mixed benefit one was there was about 7 or 8 questions, and 6 of them were member benefits, and 1 of them ended up being a death benefit. So largely they were considered to be member benefits as well. Why do I highlight this? Well, basically the ATO's position on all of these circumstances is if a member of a self-managed super fund request their payment out to themselves as a member and they die prior to the payment being requested, then the fact that the trustees know that the member has died, and almost exclusively the trustees are going to know that the member has died, the ATO's position is it will always be a death benefit. So unless that money comes out of the fund prior to the moment the person passed away, or is it sitting in their bank account prior to that point, it is going to be a death benefit, right? So, the whole concept of trying to plan for that moment and request things early really doesn't stack up with the ATO, and we need to make sure people understand that and that people can ensure that they pay their benefits out prior to their death if that is the key issue for the beneficiary. So it's just one that I wanted to highlight there. So from a summary point of view, to bring this to a close, really it's just about having that appreciation, having that understanding that it's a significant area that we need to be mindful of and need to continually be reviewing. So making sure that we understand what's going to happen from a trusteeship point of view, and ensuring that the right people have control of the fund when a member passes away. Doing these health checks, so as I said, incorporate into the annual requirement of the fund to review the estate planning needs and requirements of the members to ensure that they are satisfying their requirements, and also getting the right expertise in to help with regards to it. But also, more broadly, from a fund point of view, things such as insurance. I've touched on that a few times today. Where are the insurance proceeds and that paid from? Which member's interest is the pension reversionary, is it non-reversionary? So there's a lot of key issues that we need to bring together to make sure that we have a successful transition from the members being alive to the members passing away and their benefits being paid accordingly. I had one more question there, which is, with the recent court case for the interdependent relationship, the court has ruled the cease of relationship has not been proved and the text message was not sufficient to confirm the relationship had broken down. Do you think the judgment is fair, and what evidence that mum should have provided to the court that can confirm they are not together anymore? So this was the case of the same-sex couple, where the son had sent a message to a WhatsApp group with to his sister, incorporating his sister, to say that he didn't want his money paid to the to his partner, who he had made a binding death benefit nomination to. And this went through, this was an APRA fund, so this was through, I think it was AMP. And in the outcome, the trustees refused to make the payment or whatever. Then the original beneficiary appealed that and said that there was a valid binding nomination in place. And then the mother appealed it to say that, well, we received this message so that the de facto relationship had ceased because of the message. And the appeals tribunal found that the mother's comments were correct, but then it was subsequently appealed again. And in that second appeal, they said, well, that text message was not enough to satisfy that condition. And so my opinion, it's very hard to give my opinion in the sense that, you know, I'm not a member of that appeals tribunal. I don't have the legal standing to be able to give an opinion, other than to suggest that it really does highlight that there's critical issues associated with the making of binding death benefit nominations and the validity of those nominations. And if there's any doubt about the validity of the nomination, then ultimately you should be looking to, you know, potentially say, well, if I don't want that money, or if there's uncertainty about that money being paid to that individual, then you need to look at where else that money should be paid. Should it be paid to the legal personal representative, which in this case was the mother, to ensure that the payment doesn't go down to that next level. So when you've got relationships that are in this instance same sex or whatever, where there is no concept of marriage, right, but it's kind of hearsay in regards to whether a relationship exists or not, then you need to provide certainty in some other way, shape, or form, and that can often be problematic. Last question: Can you further elaborate the insurance on reversionary and non-reversionary pension? The insurance proceed is counted towards the transfer balance cap in non-reversionary, and in reversionary would the insurance proceed be counted towards transfer balance cap in 12 months' time? No. So reversionary pension, the insurance proceeds will never be counted from a transfer balance cap point of view, because a transfer balance cap is a one-time position. So where it will count is if you then commute it. But of course, it's a death benefit, so the commutation is kind of irrelevant unless you're rolling it to another institution. But the transfer balance cap for reversionary pension is only measured at the commencement time, so therefore any fund earnings, which includes the insurance proceeds, are not going to be added to the cap. But then if it's commuted, it's the value of the commutation that will create the debit to the account, which would then help if you're rolling that pension to another institution by getting out of the SMSF, versus non-reversionary, which in that instance, in non-reversionary, the insurance proceeds are going to count and potentially create a problem for the member. So look, that's it. It's one of those things. Estate planning is certainly a topic that we could all talk about all day. There's so many things to factor in. So that's why I raised it under the concept of considerations. So thank you all for attending. Next webinar in a month's time, we'll be dealing with related parties and the problem dealing with related parties. And really, it's not a problem issue. It's more about identifying all the issues in light of a number of recent court cases that deal with SMSFs and related party transactions. So that'll be the focus of the next event. So thank you for attending. As I said, you will get the slides, and the slides will have the links to those various documents. So great to have you all on board, and I look forward to you all joining us in our August webinar. Thanks a lot, and bye for now.